So much fear, so much panic, so much destruction in the stock market. What's up, everybody? Michael Silva here. Welcome to the Stock Market Brief Show, the show where we use technical analysis, internet market analysis to get a good idea as to where the market might be headed next. I got a lot to talk about in today's video. Might go on a couple of rants, got some important charts. I want to talk about today's volatility and what I expect to happen here the next couple of days. Let's go ahead and get into today's episode. All right, everybody, welcome back to the computer. If you haven't done so already, make sure to hit the thumbs up button. I'm not going to do that again, actually. Hit that thumbs up button. Subscribe to the channel if you haven't already. It helps push the video out to more people. Thank you for everyone that participated in that the other day. Over 900 to almost 1,000 thumbs up that were hit. I really do appreciate that. Video helps get out, like I said, to more people, gets more views, helps me out too. Takes a lot of time to put together all of this content. Let's hop into the show. First and foremost, I want to point out, which most people have not pointed out yet, but the indices are negative on the year other than one of them, the Dow Jones Industrial Average. So for the first time in the year, it's been like a couple of trading days, we have the NASDAQ 100, which is down over 3% year to date. We have the Russell 2000 outperforming the NASDAQ 100, and then we have the S&P 500 outperforming that, and then the New York Stock Exchange, more broader markets, down about 0.5%. Now, in yesterday's video, I talked towards the end a lot about position size. I'm starting to talk more and more about that because, one, me personally, I like trading breakouts. A lot of people like trading breakdowns, breakouts, pullbacks. There's so many different ways to go about trading this market. And if you're a breakout trader, in times where you see this sporadic volatility, breakout trades don't work all too good. So you need to be very, very patient, and you have to find very high probability risk to reward. As much as possible, you got to minimize that risk. So, you see the S&P 500 down 1.4%. I've taken only, I think, 5 trades now, and they've had such a low risk profile. But out of those 5, I have had 1 out of 5 trades that went in my favor. Now, you might think, oh, man, you're probably losing a lot of money. I'm not losing pretty much anything. I'm still outperforming the S&P 500. I'm actually almost outperforming the New York Stock Exchange. I'm slightly down right here within this range over here. So it's all about really honing in on your position sizes and managing and mitigating your risk. I've been talking about the sell signal here. I've been talking about all of these different indicators coming into play saying, hey, is this the time that you want to put your foot, full pedal to the metal and go full bore? Absolutely not. This is not the time to be doing that. Leading up to where we currently were. What you want to do in these situations, if you're a similar type trader, or maybe you're a breakdown trader and you're playing shorts. Now, if you're a shorter and you just had a wonderful couple of starts to the year, congratulations. But what I'd say now is if you're still holding those shorts and you haven't covered, right? Expect some blowback rallies to take place. That's what happens, especially if we go into a prolonged bear market. What you typically get is you get these rapid sell-offs, but you get rip-roaring rallies too. Okay, so it's a time to still, both ways. You need to be very aggressive and you need to be very tactical in this environment until we get some clear picture as to what's taking place, okay? We had the Fed come out, the FOMC meetings. I'm not going to get too into that, but if you haven't watched this video, it's a few videos ago. I was talking about kind of my expectations going into 2022, and it was basically based around, don't fight the Fed. And that goes both ways, right? If they are really going to be tapering and increasing that speed, which they haven't done so yet, right? It's going to be a more difficult market to navigate, especially when you start looking at these big cap tech stocks, which if you take a look at the heat map today, just some deep red in these big mega cap names. And that puts a lot of pressure, obviously, on the NDX, the NASDAQ, the Qs, right? And then you can see across the board, we had a lot of red there too. But overall, like when you really look at it, I mean, it wasn't too horrible a day from a volatility standpoint, actually. And, there's a lot of fear right now, it seems like, but there's really not. And I'll get into that here momentarily. If you look at the Russell 2000 heat map, now that thing lit up like something that's really red. Rudolph Snows, there you go. Let's continue on. moving down here, the list. Now, if you take a look at some of those FANG stocks, look at Google. We've been talking about how important it is to watch Google. And you can see here, we've been seeing some volatility kind of contract. And then you can see as it contracts, you know, expansion leads to contraction. Contraction leads to expansion, and we had an explosive move to the downside pretty much from open to close. Just a shave-headed candle right there, down 4.59%. That is a pretty aggressive move here and a big name, and that right there can put a lot of weight on the S&P 500. When you really look at this though, since last year, it's still up tremendously, and it's still within a overall bullish trend. Now you can see as the Bollinger Bands were getting really tightly contracted, now we're breaking outside of that, but we're still above a 200-day upsloping moving average. Now, what I also want to call out is that breakdown came on explosive volume. So what I want you to pay attention to going in to the remainder of this week and following, because this was a pretty aggressive sell-off. If you are seeing high volume breakdowns, okay, so the candle breaks down, you see high volume, and then you see the stock rally up and everyone's yay, but you see it on declining volume, be very hesitant on this yay moment right there, because it could just happen once again, snap back down, and then pow, another big round of volume comes right in. Okay, so that's very key to be watching out for. And we've been talking about that on the indice charts, which I'll point out once again. Tesla was down 5.35%, still above that 50-day moving average. I think it was last year. I think last year we saw two 40% drops or two 50% drops. I know one for sure, and I feel like we've saw two from maybe this point, from this point, 1250 down to around 900. I don't know the percentage point drop right there, but we saw two big drops. So don't like rule it out that we can't see Tesla see another big movement to the downside. And this one holds some weight too on the S&P 500, being how big of a mega cap it is. Same with Nvidia down 5.76%. Closing below that 50-day moving average, coming into that lower Bollinger Band. We're still above a key level right here, that 270. If that starts giving way, yeah, be a little bit hesitant. We're still in a powerful uptrend as it stands right now. So you can see this come up here, and then we could see it bounce. But like I said, watch for that bounce. If the bounce comes and it's on this minimal little volume, it could be a bear flag, and then we could see a breakdown, bam, on more bigger volume. So that's what you got to kind of pay attention to. If you take a look at Adobe has just been getting obliterated. This just goes to the narrative. The reason why I'm showing this one, it's overextended to the downside. Two, big, huge move to the downside. Boom, volume supports that move to the downside. A lot of people were looking to play this bounce right here. Now I want to point this out. We saw this big explosive move, break down on large volume. We saw a rally. What do you see here? The rally took place on declining volume. So that right there in itself flagged into the 200-day moving average, all right? And that was the area to potentially put on a short. And you can see, pow, right to the downside. So that is what you want to pay attention to if you are looking to short this market, or if you're trying to, if you have like a position and you're like, I don't know, I'll just hold on to it, maybe. And, if it comes right back up to a key area of resistance and it's on low volume, just be mindful that, hey, this could happen, okay? That's why I wanted to show you that. If we take a look at the relative strength between the FANGman stocks, you can see continually to break down here across the board. Apple still remains relatively flat, so that is, the strongest one of them at this particular point in time. And I want to revisit this chart here, okay? This is so important to pay attention to, and, everyone's going to say, oh, this time's different, this time, blah, 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 blah. This has not happened before. This is so different to all the professional traders out there, or macro thinkers, whatever the case may be, technical analysts, chartists, you name it. There hasn't been a time where we've seen the market rally how high it is right now, at all-time highs, to see the percent of stocks above the 200-day moving average get completely obliterated from the NASDAQ composite. So we're getting a reading of 27.66. That means, so 73, if I'm doing my math correct here, 73% of the stocks in the NASDAQ composite, which has over 3,300 stocks in it, are below the key moving average. That right there, it's not that healthy. Think of like a Think of a house, right? If you think of a house and you're like, yeah, and then you like, no, think of a skyscraper. That's a, a big old building. Yeah, think of a big old building. Yeah, there we go. Big old building with windows. And it's just completely infested with, things that destroy the cement and foundation, some termites. That's what we're seeing right here. We are seeing just an obliteration of mold and termites taking apart the NASDAQ composite, but yet it's being held up by very few names. And this typically can catch to the downside. Maybe perhaps these catch up. This was, I saw someone in the comments, they said, hey, it was the stealth bear market, which it was. Perhaps we're going to get a stealth bull market. Hey, that's always possible too, but just be mindful that this kind of stuff, it will resolve, and to which way, I do not quite know yet. So we just need to be what? Mindful. Now, if we take a look at the NASDAQ composite as it stands right now, we've been paying attention to this. The last time I showed this chart was this rising wedge when we were breaking out. I post on Twitter. If you don't follow me there, you can follow me there. But look at this. We're getting overextended to the downside on the hourly time frame. I like to see a positive divergence there, and I'd like to see a positive divergence there as we come into an area of support. But overall, we're getting overextended and we're in a channel still at this particular point in time. So not much to report there. If we come down into this zone, I'd start looking for potential patterns to set up and or potential bullish divergences or overextended trades potentially to take. All right, now why are we seeing all of this action all of a sudden? Well, the 10-year yield continues to perpetuate itself to the upside, up 12.76% on the week. I wouldn't be too surprised to see this thing continue to climb up here, but I think that there'll come a time here shortly where TLT, Treasury bonds, will probably catch some sort of a bounce. That might be tomorrow, maybe not. We're still within a trading range here too as well. You can see at this particular time, so this is around October, we have a higher low still, so it can reach potentially down. And when I focus in on the TNX, let me go back to the TNX. Here we go. TNX, October right here. You can see that it's actually, interestingly enough, coming out a little bit further than these October highs right there. So the TLT, the bonds, is putting in, it's not quite as dramatic of a move to the downside as this 10-year yield is moving. It's an interesting way to potentially look at it, but that could change. So as it stands right now, what I found so interesting today was the market did get hit to the downside pretty hard, and we actually didn't see, safety go into bonds today. It actually went down. So perhaps we get that bounce here very shortly to potentially just a little relief bounce in the Treasury bond. So that is what I'm going to be looking at going into tomorrow. If we take a look at TYX, saw a nice big move to the upside there, up 9.61% for the week. This is the 30-year. If we take a look at the 5-year, that's up 13%. So when we look at the 30 and 5 spread, it is, you can see here that it's going to be basically curving to the downside, so flattening more towards that inversion. And you could see here we broke out of this basing pattern, and then we kind of consolidated. Now we're coming up to that 200-day moving average. It's declining right there. So if you look at the 30 and 5 spread, as I stated, 30 and 5 is down here. It went up a little bit, and then today you can see that it kind of curved back down a little bit, flattened. Still far away from inversion at this particular point in time. You see the 10 and 2s started to rise, but today started to move down slightly there too as well. If we take a look at the dollar, now we're starting to see that this big move over here and this move up, now we're starting to see that weakness in the S&P 500, which we kind of have been talking about. We'll see if the dollar wants to continue to perpetuate itself to the upside as a kind of a safety trade, or if it wants to continue to consolidate it. There's not much price action, not much things have been taking place. If you look at the 11 sectors in the S&P 500, let's move on. Real estate and technology down there at the bottom. Real estate got pretty obliterated, and typically, like it hangs around utilities, consumer staples, and healthcare. These are kind of like safety trades, and real estate was way down here, so I wouldn't be too shocked to see real estate potentially get a little bit of a bounce come into tomorrow, as it could be a little overextended there to the downside. So that is one to potentially watch heading into tomorrow. Now, should we be surprised that we're seeing all of this red across the board? Should you be surprised of the velocity of this move? If you've been watching this channel, the answer should be no, and let me explain why. Okay, first off, we talked about, there's quite a bit of things that I want to talk about here, but SPIP over GOVT, we talked about this kind of hitting a couple of times, and it's a leading indicator of volatility. It's been working. It's not the holy grail. I couldn't tell you why, but it's a correlation that I found, and it happened 1, 2, 3, 4, 5, and I'm just going to count this as 6 times right here, and pow, we got that little burst in volatility. So you can see we've been getting pops of volatility as soon as, for some reason, Treasury tips outperform Treasury bonds at a rate of change that moves up to that 1.3 or 1.5 on the 10-period reading. So, overall, pretty interesting. That gave us a heads-up notice. Once again, we also had the S&P 500, the BP bullish percent index over here, RSI, getting to that overextended area. That was a little bit of a, do you want to, I kept on saying, is that where you really want to go long? No, not necessarily. Same here with the NIMOT traditional calculation. We had that negative divergence that did play out there to extent if it can keep continuing to go down. I do not know quite yet. But here on the NIAD, we also talked about the negative divergence, a high to a lower high. We had a high to a higher high there. But I will call out that this reading is actually extended to the downside. We can get a little bit lower here, but just be mindful that that is actually an overextended reading to the downside. And you can see we had a pretty darn aggressive move. So to see some sort of gap up, like I said, we can get a rally, but just start to look at the volume to see if it's actually something that can withhold itself. Now, this is why I really say, should we be shocked by this? And the answer is no. We talked about what the options market was pricing in as far as volatility goes, and it was actually pricing in a minimal amount of volatility than it's been basically expecting for these past couple of weeks. So this week, it expected around a $60 move, which is about a $6-7 move here on the SPY. And that was basically up to 482 to down to around 467 and some change, 467.50 and some change. And you can see here, it's been just going sideways. And then today we came right down to that lower range of that move, which happens to coincide with the previous area of resistance, previous area of resistance, previous area of resistance. Okay. So it shouldn't be too shocking. And you can see that when you look at the VIX. When you take a look at the VIX, look at this move. Okay, we moved up, right? Contraction leads to expansion. We popped up, getting a little overextended. But does that really spell out like fear? I mean, it shouldn't. Like, that's not a big move at all. From a percentage basis terms, 16.68%. But we've seen more explosive moves, and today's price action shows, it was pretty dramatic, but on the VIX, it just doesn't, that to me doesn't spell out a reason to be scared right here. It just doesn't do it. Now, we still have 4 gaps above us, actually a 5th gap above us, and if it starts continuing to head up that high, what can we expect in the S&P 500? Well, I'll show you right now. In the S&P 500, if we start cracking down through this expected move this week, okay, and we start getting significantly lower, that's when I think you can expect to see a lot more fear coming into the market, because this is kind of like, if you look at this upper edge right here and this lower edge, and even in between, this is just, the expected move. It's the happy place. But if you start getting outside of that stuff, you're going to have hedging take place, and hedging could lead to extreme bouts of volatility. Could be to the upside, could be to the downside. So when we start getting out of those, be mindful. Now, I wanted to pull up Thinkorswim. I'm not going to pull it up here, but I already did. And what I want to show you is that it was at the beginning of the week or end of last week, it was pricing in a move from 482 to around 467.50, which was about a $6 move or so on the SPY. And we have 2 trading days left, and the end of today, okay, on Wednesday, look at the expected move here. It's literally just as big. So I think that, we're going to still continue to see some volatility. It's actually pricing in around a $6 move where it can come down to this 50-day moving average or slightly below there, or it can bounce right back up to around that 475, just below that. So if we do get down here, that could be a potential long position, especially if it's a quick hit. And then you could say, okay, I'm going to take a good risk to reward trade here, and I'm going to give it a shot, okay? But also to pay attention to is if we start moving up to here, okay, if we start getting up to this range, pay attention, like I said, once again, to the volume, because if it comes up here, bam, bam, Wednesday, the next 2 days, and we end up around here, If we're doing so on minimal volume, that's a little bit of a warning sign, right? We talked about it's consolidating and it rallied on low volume. It's been consolidating and then it just broke down on high volume. All right, so that to me, it's not all that great. That's not a good sign to see breakdowns on high volumes and breakouts on minimal volume, okay? It's the beginning of the year, right? And this low volume rally right here was at the end of the year. And you typically see low volume at the end of the year. And you typically can see more volume come back in at the beginning of the year. So it's still, once again, a very hard market to determine. If you take a look at the Qs, down 3.7%. That was a nasty move. I don't have the expected, what options we're expecting, but I can tell you this. I looked at it and I do remember this is way outside of that move. It's actually about it's about two deviations from that expected move. So right here, you know, if we start continuing to move down, it could be very aggressive, especially if the big tech continues to sell off. Now, being that it's two standard deviations down, is this the place where you'd want to go short? Just like how I said, is this the place where you'd want to go long right here? No, you don't want to go long here, just like you don't really want to go short right here. Can you get lucky and we get some more selling? Yes, absolutely. But what I said is, what I want you to pay attention to is this. We're coming right back down to a previous area of support, and previously resistance, and we came up here, so we're trending sideways. This is a very aggressive move, okay? So think of a rubber band. You stretch out a rubber band, and what happens if you let go? It snaps back, okay? Now, being as this rally came up on low volume, this broke down on high volume, even though that it's extended, yeah, we can head lower, but be mindful that, you know, that is not a good entry for a short position. You want to see this rally up, you want to see declining volume, and then you want to sell, either take some profits and or short into area of resistance. That allows you to minimize your risk. Everything that you should be doing in this market should be focused around risk. That is it. That's all you need to do. Stop worrying about how much you're going to make and how fast you can make it. That's the worst thing that you can do for yourself, because it's going to put you in the wrong mindset and it's going to get you in the wrong type of trading. Focus on risk first. You want the lowest probability risk trades and you want the maximize the highest potential, okay? And times of high volatility, people get chopped up. When you get low volatility, that's, you know, you could be blindfolded for most parts as things continue to drift higher. So just be very, very careful in volatile environments. If we take a look at the 2-hour time frame, we are coming back down into this 378 range. This is just to give you an idea of where we came from, where we might go. So if we do get an explosive move to the downside, you know, we could get that rubber band snack back if it continues to head lower. This is 2-hour time frame though, and we're already overextended to the downside. I wouldn't be surprised if we start opening up tomorrow. What I would like to see is actually a gap down and then turn green. So it'd be a red to green candle, but chances are we'll probably get some sort of gap up. We might get a little bit of a rally, but you know, we got to pay attention to what the data brings. You know, we need more data to determine what kind of move it's going to do. Because as it stands right now, that's, you know, there's not really a good trade here. I like to see price action. Like, I don't like to take trades. I could fade. I'll fade a trade extension, but it's a very short term. But if I'm taking like a swing trade, I want to see volatility contract. So that means I want to see price action get tight. I don't want to trade a short-term trade in a big bout of volatility in front of my face, okay? Because if you have a lot of volatility, that means the risk to reward is all skewed. If we take a look at IWM, that was a massive blow to the downside too, down 3.39%, okay? That was a pretty aggressive move, but we kind of said, what did we say? Okay, we walked through this the other day. I'm going to walk through it again. We broke out. Yeah, everything looks good, but I said pay close attention. Running up to these moving averages, you can see the bodies of the candle were big to smaller to even more narrow with some topping tails. If you haven't watched that, go back and watch it. I think it was yesterday's video. Okay, maybe the day before. I can't remember. Okay, and we started to contract and then we expanded. We broke down on higher volume, okay? That is why it's so important to update stop losses and take profits when you got them in this environment. IWM on the 15-minute time frame getting pretty frothy down to the downside right over there. I've been ranting on, so I'm going to try to move this a little bit quicker. I only got a couple more charts yet. Hold on. Here we go. Gold. Gold was up on the day. Nothing too crazy here, right? We're still just kind of tracking up, but we're ultimately sideways. You know, I still can't believe that one trade that took place. Like, I will be shocked if that person comes in the money. The spread that I'm talking about from the other day, I say it was like a thumbnail that said, keep an eye on it. Oh, wait, no, I'll just show you it if you haven't watched it yet. I have the little picture right here. Why isn't it working? There we go. Yeah, this one right here, keep an eye on it. There was like a gold, I think it was that one, where I put in a chart, a trade that I found on Thinkorswim for gold, and basically it was a 210, 230 GLD bullish call spread. And, you know, it was 23,000 contracts. Oh my gosh. It basically needs to see this gigantic. It was a big bet in my opinion. It was like almost $1 million bet to potentially make like 43 million. Absolutely crazy. So if they get that right, somebody knew something, that's for sure. If we take a look at some crypto now, Bitcoin to gold ratio, the Sailor to Shift tool, we have turned back down, unfortunately. Give it some time. We'll see here. There'll be a time where it turns back up. You know, well, it's not there yet, okay? And we're starting to break down from that kind of bear flag. Maybe this is just a quick little flush. It's too hard to tell right now. This is what we've been talking about. This is what we've been saying to be careful for. This is why we've been saying monitor your risk. We've been on a sell signal since early November, and it is now down substantially, the price of Bitcoin. If you take a look at silver, why is silver coming up right now? Silver, I'm not even going to talk much about this. It could be a potential bear flag. It broke out of a wedge, and we're within a trading range. Let me go back to Bitcoin. I had those out of order. Okay, so here's Bitcoin. So we did break down from this. Bam, flush to the downside, and guess what? It came in. That breakdown happened on high volume. Okay, so now what we got to pay attention to now is if we start moving back up, and if it's on lower volume, just be mindful, be careful. Okay, we did crack down through this previous low. Maybe we're going to get that little bounce right now. It's very hard to determine. If we start cracking down through this, get a daily close there, you know, maybe we come down to this 40,000 range and just go from there. And if that's the case, then it's going to look like obviously another head and shoulder pattern, which head and shoulder patterns have not been playing out all too well. So I wouldn't put too much weight on that exactly. But that's where we're at right now. I don't see the trade from a bullish perspective at this particular point in time. I would need to see the relative strength of Bitcoin start turning up, and it has not done so at this particular point in time. And also Ethereum, same thing. We cracked actually this trend line, but we're basically on it right now. You know, it's acted as resistance, support, and we are coming into. So if you are trading, or if you want to take a better type of entry, it does seem that Ethereum would be the better player right now, and just from a technical perspective. And the only reason why I'm saying that, because they do kind of move hand in hand, is because it was outperforming Bitcoin from a relative strength standpoint. And then two, the 200-day moving average price is still above it, and it is inclining. Okay, so that's the only reason why I would say Bitcoin over Ethereum. As this chart, Bitcoin is the 200-day moving average is flat, and the price action is clearly below it. You know, some people might say, well, that sounds like an opportunity to potentially go long here and just get a better entry. And you might be right. But if you do that over the course of time with various other trades, you will notice that you can wake up in certain stocks, just like Adobe, and be significantly further down. Okay, so manage your risk appropriately. I will say, though, right here, nope, actually, never mind. I was going to say this is a positive divergence. No, it's kind of that is a positive divergence. RSI hit here to a low, higher low there, and you can see from right here, bam. So you do have a little bit of a positive divergence taking place in the price of Bitcoin as it stands now, but if it keeps going down, that's going to get taken out. All right, everybody, that's all I got for you on today's episode. I ranted a lot, I went off on a lot, and talked about a lot, but I want you to just, once again, pay very close attention. If the market starts bouncing and it's low volume bounces, be mindful of that. Take profits when you can. Focus heavily on your position sizing. If you want to outperform the S&P 500, if you want to make consistent money, and you're not focusing on risk, which is one of the only things that you have complete control of, okay? You need to start focusing and start getting very good at managing risk. There's only 4 things that you can control in this market. It's what to buy, how much of it to buy, when you buy it, and when you sell it. Those are the 4 things that you have complete control of. You can't control how many winners you have or how many losers, but you can control those 4 things. And if you get good at focusing on those 4 things, it'll take care of itself. The results will speak for themselves. I promise you that. All right, everybody. Once again, have a good night. See you later.